75%. Let that sink in for a second. That is the stark, kind of jarring reality of the fintech industry right now. Despite being one of the absolute fastest growing sectors in the global economy, 3/4 of all fintech startups fail within their first 2 years. So why the massive drop-off? Why are so many companies hitting a brick wall? Well, the data points to three main culprits. First up, compliance failures. Manual KYC, know your customer processes, they're just missing critical red flags, which leads to failed audits and regulators stepping in. Second, fraud and security breaches. Traditional rule-based systems are quite frankly failing to catch sophisticated modern fraud patterns. And third, poor user experience. Giving users a generic static dashboard, that just doesn't cut it anymore. Today's users demand highly personalized, proactive financial insights. But look, where there's a ridiculously high failure rate, there is also massive opportunity. If you can solve those three core problems, the stakes are incredible. The fintech market is projected to be worth $450 billion by 2028. That's billion with a B. The businesses that build the right, highly secure AI-driven infrastructure today are going to completely own the competitive advantage tomorrow. Welcome to The Explainer. I'm super excited to have you here today. Let's dive right in. Today, we're laying out the exact step-by-step blueprint on how to develop white-label financial risk management software in 2026. Here's our quick roadmap for today. We're going to cover the 2026 fintech reality, look at white-label API foundations, dive into securing the data exchange, explore generative AI credit decisioning, and finally wrap up with governing the AI black box. All right, let's jump right into Section 1, the 2026 fintech reality, looking at market gaps and timing. Moving into Section 2, White Label API Foundations. Okay, so to deliver those seamless experiences, instant account opening, frictionless verification, you absolutely need the right plumbing. And what's staggering here is the sheer volume of data we're talking about. Open banking APIs are basically the secure bridge between traditional banks and third-party fintech providers. In North America, this is heavily driven by the FDX, or Financial Data Exchange. It's this massive industry-led initiative standardizing exactly how financial data is shared. And it's evolved to cover over 600 distinct data elements. It's the foundation that lets you validate someone's income or confirm their banking history in literally seconds instead of making them hunt down and upload clunky PDF documents. Now, the way this interoperability works kind of depends on where you're operating. For example, global open banking over in the EU and the UK is heavily regulatory mandated. FDX in North America, however, has been more of a voluntary industry-led initiative, though it actually covers a much broader chunk of the financial data ecosystem beyond just banking. But honestly, regardless of your region, building on these interoperable API standards, it's completely non-negotiable for modern white label platforms. Which brings us to Section 3, securing the data exchange. Because think about it, once you open up 600 data elements through an API, your attack surface just explodes. So here's the mandatory security baseline for 2026. Step 1, you've got to have OAuth 2.0 and strong customer authentication using biometric multi-factor auth. Seriously, SMS text verification? That's out. Step 2, we have to shift to hybrid post-quantum cryptography for data in transit, right alongside AES 256 encryption at rest. This protects against that terrifying harvest now, decrypt later threat from emerging quantum computers. And step 3 is strictly enforced role-based access control, just to make sure data is only accessed with the absolute least privilege necessary. All right, Section 4, generative AI credit decisioning. So as we move from that basic data layer up into the core intelligence of the platform, we're seeing a fundamental change in how credit decisions are actually made. Legacy credit platforms are, they're rigid. They rely on static scoring models, predefined thresholds, and slow manual human reviews. And they break down completely the second context matters, like if a commercial borrower has short-term revenue volatility just because of a smart business expansion. Generative AI decision engines, on the other hand, are totally dynamic and context-aware. They can instantly analyze mountains of unstructured data, right down to the tiny footnotes in financial statements and industry commentary, and they do it all in real time. So what does it actually mean to wire this into your white label software? Well, the AI evaluates the full context of a borrower.
It can easily tell the difference between distinct recurring income and just a random one-time deposit, which completely unlocks underserved segments like gig workers. Plus, it slashes false positive fraud alerts by an astonishing 80%. And it doesn't just stop at origination either. It provides proactive portfolio monitoring, alerting relationship managers to sketchy shifts in payment behavior way before a delinquency even triggers.
Finally, Section 5, Governing the AI Black Box. Now, all this incredible power brings a massive challenge. Moody's maps out the evolution of this model risk perfectly. Look at the Gen 1 models on the left. Those were your traditional scorecards. Highly transparent, totally deterministic, and fully controlled. X goes in, Y comes out. Simple. But jump over to the far right, Gen 3 AI systems. We're talking LLM-assisted tools and autonomous agents. They're unbelievably capable, but they're stochastic, meaning you can give it the exact same input and get different outputs. It's essentially a super black box that completely breaks traditional supervisory assumptions. So here's the crucial takeaway. Governing these Gen 3 systems means you have to totally abandon old-school static validation cycles. As Moody's points out, the mitigations have to evolve. You can't just validate an LLM once a year and call it good. You need continuous observability and real-time monitoring. You've got to run behavioral tests using adversarial prompts to try and break it. And most importantly, you absolutely must maintain operational controls, like human-in-the-loop oversight for any high-stakes credit decisions. Let's look at how Moody's actually puts this into practice in the real world with their early warning system. They basically string all these different model generations together into one perfectly governed pipeline. Step 1 uses an LLM to extract events from messy, unstructured news streams. Step 2 uses a machine learning algorithm to cluster all those events together. And then Step 3 feeds that newly structured data straight into a traditional credit risk model. When you look at the architecture, it's brilliant. On the left, you have that highly unpredictable Gen 3 LLM. Because it's non-deterministic, its behavior is constantly monitored and quantified. That output is then passed to the Gen 2 clustering model and finally lands in the highly controlled, very predictable Gen 1 credit risk model on the right. By trapping the unpredictable AI inside a really strict workflow and validating the inputs and outputs at every single infus layer, they get all the amazing AI capabilities while ensuring end-to-end regulatory compliance. This, right here, this is exactly how you build scalable risk software in 2026. I really want to highlight this powerful quote from GDS Link because it hits the nail right on the head, summarizing everything we've talked about today. The future of lending belongs to institutions that combine advanced AI with disciplined credit governance. I mean, that's it, right? It isn't just about having the flashiest, smartest AI. It's about having the most trustworthy, governable, and secure AI infrastructure. So I'm going to leave you with this final thought to ponder. Take a really hard look at your current technology stack. Is your infrastructure creating friction, or is it actually enabling you to safely scale? Are you just reacting to the future, or are you leading it? Thank you so much for joining me on this explainer. Keep learning, keep building, and I will catch you next time.